The United States government cannot afford a recession. In today's video, I'm going to tell you why recessions are no longer allowed in the US. Essentially, they're banished. If we do suffer negative GDP, the Federal Reserve and the governments are going to have to step in due to necessity. Because if we enter into a recession, it doesn't just weaken the economy. It sets off a chain reaction that's going to hit the US governments, the bond markets, and your personal finances all at once. And most people don't realize how connected all of this really is. And that's a shame, because if you understand this, then you're going to know how to play your cards right, especially in the stock markets. So this information is especially important if you're a stock market investor. So let's review why recessions are no longer allowed in the US. The first reason is tax revenue. The US government runs on tax collections. We're talking about income taxes, corporate taxes, capital gains taxes, and payroll taxes. Now here's the problem. When there's a recession, tax collections drop. That's because people lose jobs, businesses earn less, and stocks decline. This means that there's less income to tax, less profit to tax, and fewer investment gains to tax. So everything slows down at the same time, and this isn't just theory. We have real data from prior recessions that shows exactly what happens when the economy contracts. So tax collections go down and the deficits balloon. Now, I want to show you the data for the past 25 years. And you're going to notice that when we don't have a recession, tax collections normally increase. And that's simply because of inflation. They print money and then the cost of living goes up. So incomes are going to go up too. Not as much as the cost of living, but incomes will still increase because of inflation. And when incomes go up, the government collects more taxes because people will have higher taxable income. But when there's a recession, you'll notice that tax collections go down. I want you to take a look. In the early 2000s, there was a recession. It was the aftermath of the dot-com crash, the tech bubble burst. There was also 9/11, which shocked the economy and damaged travel, tourism, and business confidence. In the year 2000, the government collected $2.05 trillion in taxes. By 2003, tax collections had fallen by 10% to $1.78 trillion. So in the year 2000, the government, they actually balanced their books and they had a surplus of $240 billion. But because of the recession and lower tax collections, in 2003, the government slipped into a deficit of $380 billion. Now, I want you to take a look at the Great Recession. In 2007, the government collected $2.57 trillion in taxes. But once the recession hit, it fell to $2.11 trillion, so that's an 18% drop in tax collections. And that caused a deficit to go from $160 billion in 2007 to $1.41 trillion in 2009. So here's what happened. People lost jobs, so income tax revenue dropped. Businesses lost profits, so corporate tax revenue declined. And the stock market crashed, which caused capital gains taxes to collapse. So everything hit all at once, and as a result, the federal deficit surged. Now, let's fast forward to a more recent example, 2020. When the economy shut down during the COVID recession, tax revenue decreased. And at the same time, government spending surged due to stimulus programs. So in 2019, the government collected $3.46 trillion in taxes. In 2020, the government collected $3.42 trillion, which is a decrease of 1%. So the drop in tax collections was not severe because the government and the Federal Reserve reacted quickly with stimulus to save the economy and the markets. However, that came at a cost. Take a look at the deficit. So you have a situation where there's a slight decrease in tax collections, right? But a huge increase in stimulus spending by the government to prevent a severe recession. So this is when the Federal Reserve and government realized that a recession was unacceptable. The deficit skyrocketed from $980 billion in 2019 to $3.13 trillion in 2020. And then I do want to point this out. This is like a notable mention. From 2022 to 2023, tax collections fell from $4.9 trillion to $4.44 trillion, which is a decrease of 9%. And then the deficit went up from $1.38 trillion to $1.7 trillion. During this period, tax collections fell due to declining capital gains, pandemic programs that lowered tax collections. There was a bunch of programs, but an example would be the employee retention tax credits. And this is the pattern. Recessions don't just slow down the economy. They hit the federal budget from both sides. Revenue goes down and spending goes up. Now, here's why this matters even more today. The problem lies with the government's national debts. The question is, when is this house of cards all going to come crashing down? So the honest answer is that nobody knows precisely when it's going to happen. However, the truth is that as the national debt grows larger and becomes a higher percentage of the GDP, we get closer to that breaking point. And because there's uncertainty of where that breaking point is, that's why the Federal Reserve and government are scared to death to allow a recession, because they want to try to keep this house of cards propped up for as long as possible. And that brings us to the second piece, the national debts. Each year, the government spends more than it brings in. That creates a deficit. And those deficits get added to the total debts. I want you to take a look at the national debt, how it's been accumulating and just accelerating. This is up until fiscal year 2025. Right now, the United States has roughly $39 trillion in debts. And that number continues to rise. This year, the government's going to collect roughly $5 trillion, and they're going to spend roughly above $7 trillion. So it's a $2 trillion deficit this year, and that's going to be $2 trillion more of additional debt that's going to be added towards our national debts. And I also want to show you the debt to GDP situation. This is from the Federal Reserve's website. It goes back to the 1960s, and the debt to GDP ratio is currently at 122%. So this shows you the debt compared to the size of the economy. The higher it is, of course, the worse our situation is. So I want you to take a look at what happened to the debt to GDP during recessions. I've highlighted in red the early 2000s, the great financial crisis, and the pandemic. Again, what happens during a recession? The economy contracts. Tax collections go down. The government spends more money on stimulus, so the deficit goes up, which means that the government needs to borrow more money. So ultimately, the economy shrinks and they borrow more money. Okay, but we're already at a dangerous debt to GDP level. But you might say, well, other countries have higher debt to GDP ratios. Well, to respond to that, I'll tell you two things. So the first thing is that those countries, they really haven't been thriving economically. And two, they don't have the reserve asset or the reserve currency of the world. As the reserve currency and asset of the world, we're supposed to be fiscally sound with a responsible monetary policy. And if we have a recession, then what's that going to spike the debt to GDP to? 140%? 160%? Again, that's just going to get closer to that point of the house of cards just collapsing. But I just want you to know that if a recession hits, tax collections fall, but government spending doesn't fall with it. In fact, it usually increases. Unemployment benefits rise, social programs expand, and emergency spending gets approved. And that causes the deficits to surge. Now, a very good question is, why is a rising debt to GDP a problem? It's because it raises concerns in the bond markets. Because here's the reality. The US government is addicted to overspending, and the US government needs investors to lend them money. Investors buy treasury bonds, notes, and bills. So these are essentially IOUs. And investors care about confidence. Confidence that the US government can manage its debt, confidence that inflation won't erode returns, and confidence that the system is going to remain stable. If that confidence starts to weaken, then that's a problem. And that leads us to the next piece of this, interest rates. If investors lose confidence in the government's ability to manage their finances, then interest rates will rise. That's because investors will demand a higher interest rate for lending money to the US government. Okay, why? Because if something is risky, then you need to be compensated more with a higher interest rate to take on that risk. If you lend money to a risky borrower, then you're going to want to be compensated with a higher interest rate, right? And the government cannot afford to pay a higher interest rates on their debts. You know why? It's because the government is in debt $39 trillion and rising fast. And the government has to pay interest on their $39 trillion that they borrowed. So this year, they're going to spend $1 trillion on interest payments, which is, of course, a lot. And I want you to think about that. They collect $5 trillion in taxes, and they need to make interest payments of $1 trillion. And if the debt goes even higher with a higher interest rates, then it's going to be game over. Higher interest payments and lower tax collections. Like, you see what I'm saying? Like, the math doesn't work out. And I want you to know that this doesn't just affect the governments. Interest rates on government debt on US Treasuries influence almost every interest rate in the economy. And we're talking about mortgage rates, auto loans, credit cards, business loans, etc. When interest rates on Treasuries rise, borrowing becomes more expensive for consumers as well. Now, I want you to think about that situation. A recession begins, tax revenues fall, deficits increase, debt rises, GDP declines, and that's going to push the debt to GDP ratio even higher. And then investors are going to get nervous, interest rates are going to rise, borrowing costs will increase, and that's going to slow down the economy even further. And that's going to create a negative feedback loop. And once it starts, it can accelerate very quickly. Now, let's add another layer to this. Deflation. At first glance, deflation might sound like a good thing. Prices go down and things become more affordable, right? And some people might say, well, I welcome a recession because prices will come down. But at the same time, deflation increases the real burden of debt. If incomes are falling but the debt stays the same, then that debt will become harder to pay back. And it's going to be no different for the governments. If the government's tax collections fall, but the debt level stays the same or goes even higher, then of course it's going to become even harder to repay, which again shakes the confidence of investors even more. With all that being said, it brings us to the main point. The United States cannot afford a recession. And I just want you to know that there's a medicine to cure a recession and deflation within a matter of weeks. It's called money printing. So it's very simple. When the economy is contracting and prices are falling, how do you fix it? You just print trillions of dollars. That's the cure. And why wouldn't the government and the Federal Reserve take the medicine? Like, if a doctor tells you you've been diagnosed with this thing, and if you don't treat it, then you're only going to have 2 weeks left to live. But if you take this medicine, it's going to severely damage one of your organs, and you'll have 5 years to live. In that case, most people would opt to take the medicine. So the government has the option in the face of a recession to do two things. The first thing is do nothing and throw the country into an economic depression, like soon. Or two, print money, prevent a recession, and deal with inflation. Of course they're going to go at number two, to stall, to buy time. And I'll say, what do the politicians care? Because they serve 2, 4, and 6 year terms. They're just going to kick the can down the road and have the next politician deal with it. My opinion is that their mentality, the mentality of the politicians is become a politician, make as much money as they can for themselves and their families and their circle of friends, and then have someone else deal with the problem. Like, what do they care? When they're out of office and the country goes to crap, they're just going to move to another country with their hundreds of millions of dollars or billions of dollars and be living like kings. And they're not going to be holding dollars. They're going to be holding gold, land, real estate, physical assets, and they're going to maintain their wealth. Okay, I think I've explained everything rationally, and I showed you the data, I showed you the logic. And listen, if you agree with what I'm saying, I'm telling you, come join me on my Patreon site. It's an investment community that is aware of everything that's happening, and we refuse to be abused and taken advantage of by the current system. So come get your questions answered. You can bounce ideas, join our chat room. I have exclusive investing content, and you can see what I'm investing in. I'm going to leave a link for you down below. Thank you so much, and wish you a very nice day. Take care.